Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's our webinar is titled Essence of Portfolio Management. So my name is Shen Chu. I'm the moderator for this session. So today we're going to learn how do we manage a portfolio effectively. Portfolio management is a very important skills that all investors must learn so that we can build a diversified and resilient portfolio that can withstand the test of time. So today we're going to study how. All right. So disclaimer, whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any companies in this webinar. So you make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker. So he requests me to keep his profile short. So David graduated with a Bachelor of Engineering Electronics, majoring in telecommunication from Multimedia University, and built his career in the telco industry for the past 10 years before turning to his passion in value investing. So prior to that, he served as an executive director in a local equities education research firm for 3 years. Then subsequently, he came out and then he founded this company, Spiral Thinker Group, Sdn Bhd, so that he can help more people to become a savvy investor. So he is also a full-time investor and he provides value investing ideas and advanced portfolio strategies for high net worth individuals. He's also often invited to speak at Bursa and broker seminars, webinars, workshops, as well as his professional comments are often featured in business publications such as Focus Malaysia. So without further ado, ladies and gentlemen, let me present the speaker, Mr. David Po.
Hi, Shane. Hi, Shane. Good evening, Shane, and everyone. It's good to be back. Shane, before I continue, I think just now we can't see your slides, yeah?
So you can't see my slide?
Yeah, just now it was blank. Okay, I just shared my slide. Can you see my slide on the screen?
Yes, I can see your slide.
Okay, cool. Once again, good evening, everyone. It's nice to see all of you here again. It has been quite a few months since my last webinar with LifeChamp as well as Bursa Malaysia. And I would like to really thank Shane as well as Bursa Malaysia for inviting myself as well as the Spiral Thinker back again, to talk about, to share our experiences as well as what we know when it comes to investing in KLSE. And I personally believe that now is the best time for you to sharpen your knowledge as well as your skills, because now the market is so bad, right? So instead of focusing too much of your energy and resources to try to find the bottom of the market, which in my personal experience is won't be possible, all right, over the in the long term. Why not, instead of doing that, so why not we spend more time as well as energy to really sharpen our skills in terms of how to do investing properly. Okay, and that's why I think this topic is a very timely topic for us to start off our webinar series as far as Spiral Thinker is concerned. And the title of tonight's topic is Essence of Portfolio Management. This is a pretty basic topic. Hope you guys will stay with me, but trust me, even though it may sound simple, the concepts are very simple, but whatever we share tonight with you are very practical. You won't find it from any textbooks. It is basically how we approach and how we execute our investments through portfolio management on our own. All right, so as usual, if you have been following my webinar since the beginning, you know that I normally like to split the topic to a few subheaders. For tonight, we will be going through 4 major agenda. The first is necessity of portfolio management. We will discuss why is it so important for us to manage our own portfolio. The basic concepts as well as how to construct a portfolio, very basic ones. the basic portfolio parameters, and last but not least, talk a little bit about how to optimize risk and performance, just the introduction. There will be a specific webinar, I think sometime towards the end of the year, where we focus entirely on how to optimize your performance in terms of whether it's timing or engineering your portfolio, okay? So stay tuned for that. All right, without much further ado, let's start off with why is it that we need to have a portfolio management system? Okay, now you may be wondering, hey David, I'm just a normal investor, you know, I'm just a simple person. I don't have a lot of money, but I mean, in that case, do I really need to know how to manage portfolio? The simple answer is yes. As long as you have, as long as you intend to invest in more than 2 companies, all right, in the stock market, right, you need to have a proper management system. Okay. Now the reasons the reasons as how we see it, I summarize in front of you here into 4 different categories. First of all, and this is very important, the main reason why we need to have a proper portfolio management system is to manage our risks. Yeah, a lot of people, when we approach investment, we only think about the return, but most of us ignore the risk, which is actually very detrimental. Remember, whatever you do in investing, all right, whether it's in equities or in other asset classes, right, the first thing you have to do or take care of is risk management. Then only after that, you think about how do we perform, all right, how do we assess our performance, and to do that, we need portfolio management as well. And of course, I think safe to say that all of us here do not have unlimited resources. In other words, we do not have unlimited bullets or cash. So we have, all of us will invest with a fixed or limited amount of money, right? So we need to know how to use these resources properly. Okay. And last but not least, although this is not the focus of tonight's webinar, but one of the reasons for us to have a proper portfolio management system is to enable us to be able to systemize as well to scale up our investment operation. Okay, so as I mentioned before, for risk management, it's really about how we deal with the exposures of our money, of our capital, in terms of what kind of industries are we investing in, as well as allocation risk. Now, allocation risk can go both ways, right? Sometimes we can over allocate to a particular stock or a particular industry. Sometimes we can under allocate as well. All right, so I'm going to talk a little bit about this later on. For the performance assessments, it is important because you need to be able to track your goals, whether the milestones or your long-term goals for in your investment journey, right? So that you know how far are you from a target. Okay, that's very important. Then only you know what to do along the way, whether you need to rebalance or you need to restructure a portfolio. Now, in our experience and in my personal opinion, right now, in the current situation with the geopolitics, with the high rising interest rates, as well as all the nitty-gritty things that is going wrong around the world, right? It is one of the best times for us to restructure our portfolio because, in our opinion, although things may look may feel very, very bad, we are really lacking of hope right now, right? But we believe this is a really good time for the market to find its bottom, to restructure itself for the next growth phase. And believe me, this is happening. It may take 1 year, it may take 2 years, or even stretch to 3 years, but it is happening right now. So hopefully you guys don't miss this chance to really multiply your wealth for the next 5 to 10 years. Okay. And the third one is, of course, as I mentioned, resource management. We need to know how to manage our money properly when it comes to investing by optimizing how we deploy our capital. And this is something new, which I have not talked about before. A lot of people do not really take care of this, which is to preserve their profits. Now, I have to ask a question for those of you who are with us tonight, right? I'm sure that even a lot of you have made a lot of money from glove stocks back in 2020, right? So, but again, knowing that glove industry is a very cyclical industry. So I'm going to talk about categorization of businesses or stocks later on in my webinar tonight. So if you understand this industry well, and it's very cyclical, it's highly going through ups and downs, and you know that in 2020 it was an unprecedented times for the glove manufacturers, right? We know that you logically you should have known that the music will not carry on forever. So if you have that logic in mind, right, you know that you need to take profit somewhere down the line, right? And trust me, try not to have this view that you can always sell at the peak or buy at the bottom, right? It's not going to happen. You may be able to do it once or twice or a couple of times, right? But if you stretch your investment journey over many years, right, it is literally impossible for you to always finding the peak or always finding the bottom. Okay, so when it comes to portfolio management, preserving your profits is one of the key things that you have to take care of, so that you do not give back all your profits back to the market when the tide turns. Okay, so the fourth one I'm not going to talk about tonight, just to let you guys know, if you have a proper system, then you can scale up. When I say scaling up means what? You can have multiple portfolios across different markets. You can be helping your family members, your children, your spouses, like myself. For my family, I have two portfolios under my name for different objectives. I have a portfolio which I manage for my wife, and I have a portfolio or trading account open for each of my children. Yeah, something for you to think about. Okay, now let's start. Okay, then moving on next, we're going to talk a little bit about basic concepts of portfolio management, as well as how to get started in what you need to do to construct a portfolio. Okay, now first of all, let's begin with the end in mind. I always like to do this, right? Engineer mindset, right? Before you embark in any project or any endeavors, right? You have to always think about what is the end in mind, what is the output or the end result that you want to achieve. Now, when it comes to investing, right? What is your ultimate objective? Think about it. Right? Of course, very simple. Right? This is a trick question, right? I want to make money. Isn't it as simple as that? Right? Don't it, whether it's you're using fundamental school of thoughts, or you're doing trading, or you're doing technical analysis, cyclical analysis, so on and so on, right? The ultimate objective is you want to make money. Okay, but there are so many ways to make money, and even before you start your journey in the stock market, right? Before you click the buy button, all right, I want you to slow down. Before that, take a couple of days to think about, first of all, how much do you want to invest? Now, this may sound like a very simple question, but trust me, a lot of investors or market participants that I know do not think about this question. They may be thinking, hey, okay lah, today I buy a stock worth 10,000 ringgit. So I just do a bank transfer before T+2. All right. Then 2 days later, I buy another stock. I deposit at 20,000. Okay. So when you keep on doing this, and don't forget, when you sell, the money comes back to you, goes back to your bank account or whatnot, right? Then how do you know that whether you're making money or you are losing money? So you have to have a starting point. So first of all, before you start your journey, right, you must ask yourself, how much are you willing to invest? Now, by the notion of how much you are willing to invest, it also means that how much money are you willing to keep aside, how much money that you do not need in the next 12, 24, 36 months, so that you can keep it in one account, one separate account for you to properly invest. Trust me, try not to invest money that you know you will need. All right. I know there are some people who are able to churn, the trades in the market in order for them to generate the cash flow that they need every month, right? This is actually a very risky thing to do. I do not advocate this. most of the people only think about the market will always go up, which is, we all know now at this moment, right? It's not true, right? So try not to embark in that kind of enterprise or that kind of project. So you have to know how much you are willing to invest. It also means that in case something goes wrong, right? And I don't even need to imagine. You don't even need to imagine you will lose everything. Just imagine if you lost half of that capital, are you okay with it? All right. So that is a very important question that you have to ponder before you start. Now, secondly, after you know how much to invest, you need to know what is your target. You need to know what is your investment target. Now, there is no such thing as I want to make as much money as possible. Okay, there is no such thing. Now, of course, there are many reasons why we want to invest, whether it's to prepare for retirement, whether it is for our education funds for our children or even for ourselves, whether it's for holiday, for some other gratification purposes, right? You must have a target. Only when you have a target and knowing your initial capital, how much you want to invest, only then you can determine what is your CAGR. CAGR stands for compounding annual growth rate. And this is very important because later on, this will be tied to what kind of stocks that you should invest in based on these parameters in front of you. Okay, now let me give you a very simple example. Say you want to, so normally how we approach this is, we ask ourselves how many years that we want or we intend to double our capital. For example, if today I want to start investing 100,000 ringgit and I want to double this 100,000 ringgit in 5 years' time. Of course, the sooner the better, but my plan is to double it to 200,000 in 5 years' time. That would translate to a compounding annual growth rate or CAGR of 15% per annum. If I'm more, I'm more gung ho, I'm more risk loving, I'm more, how to say, I'm more rushing. I want to do it in 3 years' time. So that would mean you need to have a CAGR of 24%. On the other hand, you say, oh, okay, I don't mind waiting 7 years or 6 years. So that would be up between 10 to 12% compounding annual growth rate per annum. Then you can compare this to other returns like your EPF. EPF just recently announced 6%, right? Or your FD. I know the FD rates are very, very bad right now, but it may change because of the high interest rate regime. Okay, then at least you know whether you should be investing in equities or not. Okay. But try not to aim for a CAGR that is on either extremes. Let me explain what I mean. If your CAGR is more than 24 or 25% per annum, right, it is actually very risky. You know what I mean? In order for you to achieve that kind of CAGR target, means you have to take a lot of risks. There's no question about it. All right. You need to engage in a lot of frequent trades. Okay. Try not to go beyond that. You may overachieve this target in 1 or 2 years, but to do it consistently every single year is actually very, very tough. I know personally, I am not able to achieve that, right? So normally, I will be targeting between 12 to 15% per annum, which means that normally I will target to double my capital in 5 to 6 years' time. Okay. Then try not to go to the other extreme of being too low as well. You may be thinking, hey, maybe you say I'm very risk averse, or I don't really need the money, or I'm a retiree, I don't really want to take too much risk. So I just aim for 6-7% per annum. Now, if you have that kind of aspiration, right, don't invest in the stock market. Put your money in EPF. Because think about it. If you're only targeting that, right? I mean, why do you need to take unnecessary risk in the market where there are so many factors and so many variables, which is happening every single day, right? Just leave it to EPF, the fund managers, for you to do it. In fact, in the EPF structure, there are a lot of funds that you can choose from as well, whether it's PRS or other vehicles. Okay, so you need to tackle these two questions first before you really venture into what to buy in the stock market. Okay, now knowing your CAGR target is very important because it will be linked to what kind of stocks or what kind of industries that you should be looking at. Okay, so we'll move on to our next slide, which is the concept, which is to link KGAR target to the kind of stock categories that you should be investing in based on your target as well as your risk profile. Okay, so there are many ways for us to approach this. Normally in Spiral Thinker, we will be referring to Peter Lynch approach of the Peter Lynch 6 categories of, the 6 stock categories, which is denoted by Peter Lynch. Peter Lynch is a very famous investor. He started off with Merrill Lynch. I think his record KGAR was, I think, more than 36% per annum or something like that. Okay, so he is a very successful investor, and his forte or his modus operandi is looking for small caps stocks with very explosive potential for growth. Okay, now in his principles, he categorized the stocks to 6 groups. All right, so in front of you, we have stalwarts, we have slow growth stocks, we have fast growth stocks, we have cyclicals, we have asset plays, and last but not least, we have turnarounds. And there's a reason why we do this pie chart in this manner. Okay, now if you follow this red arrow, red circular arrow here, you notice, and there's a title here called risk, right? You notice that the risks of the stock categories, as we move down this pie, will go higher. Okay, now meaning stalwarts will carry, typically they will carry less risk than slow growers, than fast growers. In other words, fast growers typically carry higher risk than stalwarts, so on and so forth. So you can understand the logic, right? Now, why do we need to know this? Because each of these categories of stocks have very special characteristics of their own. Okay, now don't get me wrong, this is not the categories of industries or sectors. It is just how the stock, the categories of the company. All right, they can be in different sectors, but they fall into the same category. Now let's just spend a couple of minutes to look at some of these. All right, so let me just zoom in for you so that you can see better. Now, as you can see, normally, so these are the 2 major things that we look at when it comes to different stock categories. We look at the expected returns, and we look at what are the recommended strategies, right? Okay, now for stalwarts, usually these are very established businesses that has been around for many, many years. They've got excellent management integrity. But the problem is they are not very high growers. So normally they are either slow or medium growers. Okay. Now in Malaysia stock market, there are a few stalwarts that which is very famous. Among them are companies like Nestle or the telcos like DG, Maxis. All these can be considered stalwarts. All right. Now, what are stalwarts good for? They are a good buffer against volatility, especially when it comes to recession and downturns, right? They are a good hedge against inflation, because companies like FMCG's business like Nestle, right? Eventually, they should be able to pass on the cost to the end consumer to protect their bottom line in an inflationary period, right? So this is a good hedge against inflation. Okay, but the problem with stalwarts is that you cannot expect stalwarts to grow in multiple folds like your fast growers, because the nature of the business, because of the nature of the business or the size of the business, right? Typically, Nestle's top line will grow maybe in the low single teens, like between 4 to 6 or even 8%. This is considered very good already. Okay, for slow growers, normally I personally would not one of my favorite categories unless these companies can promise very high dividend yields. Now, this is one of the characteristics of slow growers, because their business has reached a certain maturity, okay, that there's not much room for them to grow. But because the business model is so successful, that they have their own sustainable clientele, so they're able to generate the kind of return every single year. And because there's not much room for the business to grow, so normally the management will give a very high dividend payout to the shareholders, which is themselves included as well. So these are among the characteristics of slow growers. Then actually, personally, my favorite two categories is the fast growers, or Peter Lynch called them super stocks, or cyclicals. Okay, and normally for these two categories, you can expect between 15 to 30% per annum. Okay, now you can understand, or I hope you can link why in the previous slide you need to go through the exercise of determining your own KR target, so that you know what kind of stocks to choose or to concentrate in your portfolio. But don't get me wrong, it doesn't mean that you should only concentrate in one or two categories of stocks. In fact, you can have all of these categories of stocks in your portfolio. But the question is how much you want to allocate for a particular stock category. Now, let me give you a very simple example. Say you're a high achiever, all right, and you want to aim for a compounding annual growth rate of a portfolio of 24% per annum, which means you aspire to double your money in less than 3 years, right? So in that case, you shouldn't put too much of an allocation into the medium or the slow growers, because you see, typically the CAGR for the stock price is between 10 to 15% per annum on the normal circumstances. Of course, in extreme circumstances like 2020 and 2022 or 2023, that one is a little bit different. But we are looking at long term. Okay, we are investing for the long term. So for the long term, typically slow growers or even sluggards, they should give you at best 10 to 15% per annum. So if you're aiming for 24% per annum for your portfolio, right, you shouldn't put too much allocation or capital into these categories. In fact, if your CAGR is 24%, then you should be focusing more on these categories, or even the more risky categories like turnarounds. Okay, because turnarounds typically, if they are successful turnaround, they can promise multi-baggers. When we say multi-baggers, we mean 100%, 200%, 300%. Okay, all right. So if on the other hand, if let's say your KR target is only 10% or 8%, right, then you shouldn't be putting too much exposure of your money, or you shouldn't be exposing too much of capital in the risky categories like fast growers, and maybe not. You can just avoid these asset plays or turnarounds entirely if your KR target is the low single digits. Okay, so this is the reason why we need to know or determine our personal KR target, so that we can link it to what kind of stocks or what kind of categories that we should include in our portfolio construction. Okay, so I hope it's very clear. It's a very simple concept, but it's very, very practical. All right, so this is just a very simple sample portfolio construction plan. So I highlight the word construction plan. It doesn't mean, it is not an execution plan. It is basically a proposal, a budget of how much or how you want to invest your capital. So in this case, it's 100K. So here, focus on the allocation part. All right. Now, last time when we do case studies like this, we put the stock names, but because Bursa, since a couple of years ago, they have been very, very stringent on, especially for a non-licensed person like me, we shouldn't be recommending stocks. So I think we had to be more careful, right? So for right here, what I did was I just put the first letter of the stocks in this real portfolio as the stock name, okay? And they are from different industries, as you can see, and they are from different niche category, okay? So in this very simple example, because this is a moderate risk, this is a moderate risk portfolio aiming to double the capital between 5 to 6 years time. So between 12 to 15% per annum. So this is the kind of balanced allocation that normally we will be constructing for that kind of portfolio. Now, for example, you can see that we have about 15%, and including this 20%, so this is about 35% in the stalwart as well as the slow grower. Okay, as I mentioned before, for slow growers, normally the reason why we include slow growers because we were looking for a high dividend yield. In this particular case, at this price of 2.90 ringgit on 9th of March, this stock UUU, which is in the industry of original this design manufacturing, they are trading at a dividend yield of close to 7% per annum. Now, this is assuming they can continue to give this kind of dividends every single year, which to me is a no-brainer, because right now, if you put your money in the bank, right, you're getting, I mean, even in FD, right, maybe you're getting at best 2.6, 2.5%, and this company, this stock is giving you almost 7%, right, 2 or 3 times more than that. So this is a dividend strategy for this stock, and you notice that I put a lot of much higher allocation. In fact, the highest allocation here. All right, now. Then you can concentrate on the red one. Yes, there is a small percentage of 5% for a turnaround stock, which is in the insurance industry. You can see here the PE and the DY is not applicable because number one, it is still losing money and it does not pay dividends. Okay, and this strategy is for passive, meaning I trust the management to be able to turn this business around in the next 2 to 3 years. So I don't mind parking 5% of the portfolio into this stock and I just forget about it. But of course, sorry, I mean not literally forget about it, meaning we won't be trading like the other active strategies, like these cyclical as well as fast grower stocks. As you can see here, we have about 60% of our allocation, which means most of our allocation, majority of our allocation into active trading, stocks in the consumer space, in agrochemical, in technology, right? So in Spiral Thinker, we focus a lot on technology because this is our core, but it doesn't mean that we will only invest in technology stocks, right? I think sometimes in different market conditions, we have to diversify. And I talk about this, I think, in my last webinar back in 2021. Okay, so this is just a typical, a very simple sample of how we construct portfolios for 100,000. Now, if your portfolio is 10K, 20K, right? It will have a different structure. You may not want to have so many stocks. You may not want to include stocks which has such a high stock price. You may want to go for the lower stock price stocks. If your portfolio is much larger, 1 million, 2 million, 3 million, of course you can have more number of shares. But of course, here is where liquidity. You have to understand the stock well by understanding how much liquidity there are, how much float there are in the market for you to buy to trade. Okay, now these steps you can easily do it in a couple of minutes or hours. Not typically it's very fast. For these steps, you may need to spend more time for you to understand what kind of businesses that you're looking at, right? And then only then translate to a portfolio plan like this. Now, you may be asking me, David, when I start with this, does it mean that I will need to stick with this through to the end of my journey? The answer is no. This is something that you have to do for you to kickstart your portfolio journey. All right. Most of us, we don't even go to this step. We just say, hey, okay, I have 100,000 today. I just open my account. My reminder is very happy. So I log in my trading account. What should I buy today? Okay, that is a very unstructured way of approaching investment. As you know, I'm an engineer, so I approach investing just like with an engineer mindset of with a proper system, with a proper SOP, right? So this is how I do it. So hopefully, after looking at this very simple step, hopefully I can inspire you to do the same. Right now, you may be asking me, David, wow, this one your table is so colorful and so complicated, right? Actually, it's very simple. There are just a few basics parameters in the portfolio, the essential ones that you need to know for you to kickstart your journey. But then you'll be asking me, so what kind of tools I can use? In fact, there are a lot of tools I can use outside. Personally, for me, for the tools, I'll talk about it later. But let's continue about what are the basic portfolio parameters that you need to know for you to start your own portfolio, right? So now the way we approach portfolio management is very, very simple, right? All you need to know is just your basic arithmetics. You need to know how to plus, minus, multiply, and divide. That's all. You don't need complex mathematics. You don't need to be a genius in mathematics, right? You just need to have a lot of logic. Okay, so when we talk about portfolio management, right, the anchor or the reference that we are always looking at is actually the portfolio value, not just the stocks, okay? Most people think that portfolio is just stocks, which is not true, because the portfolio is consists of two components. The market value of the stocks, it can be 2 stocks, it can be 1 stock, it can be 3 stocks, it can be 20 stocks, right? Doesn't matter. But collectively, these stocks have a market value each at the end of each day. So this forms the market value of the stocks. And normally, this will be the bigger chunk. Next is something that most people ignore or tend to neglect, which is the cash balance part, right? Now, cash balance is very important because this will determine how desperate you are, especially when during a market crash. And there is an actual science on how you can manage your cash balance properly. And we talk about this in the portfolio time. Okay, now, and this is very important. And normally, you know, okay, when you start a portfolio, you open a trading account, you open a CDS account with your favorite broker. Normally, now you can only, I will advocate cash upfront, meaning cash only, no margins. Please don't play with margins unless you are very seasoned. For new investors, I would advocate cash upfront accounts. All right. Okay. So most of the time, you start with depositing your cash into your trading account, which normally sits in a client trust account. Okay. Then after a while, you may want to buy stocks, right? So when you buy stocks, what happens is you use the cash. The broker will take the cash from your trust account and deduct it from your trust account to buy the stock, and then you, in your CDS, which is your central depository system account, you will have that stock name appearing in your account. Likewise, when you sell a stock, all right, when you sell a stock in the market, you get cash, the cash will go back to your cash balance. That is why I advocate to only have a close-ended portfolio. Try not to operate portfolios which is open-ended, all right? Because number one, as I mentioned, you don't know what is your initial capital, and you won't know how to tweak your performance or how to tweak your portfolio to be able to achieve your intended target at the end of the day. Okay, so most of the brokers in Malaysia, right, when you open a trading account, they will also automatically open a trust account for you, and the trust account is where you deposit your cash. It is where your broker will deduct the cash from when you buy a stock. It is where your broker will deposit the cash into every time you sell a stock. Dividends and interests by right should also go back to this trust account. But unfortunately, for interests, I think most of the brokers, they will automatically transfer into your trust account. So this is a fairly automatic process. And yes, there are brokers. In fact, I believe most of the brokers in Malaysia today do give you interests, daily rest interest, but paid every month into your trust account. Okay. Now, dividends is a bit tricky. Because since a few years ago, I think the SC has a new ruling where the dividends do not go directly to your trust account, but it goes to your registered savings account. So which means that the cash received from the dividends are sitting elsewhere. And you have to manually, you have to discipline yourself to plow back all the dividends that you receive into your investment portfolio so that you can grow it. All right, and this is very important. So this is a very basic concept, very simple, but very, very practical. And that's why we only advocate to have to invest as a closed-ended portfolio. Open-ended portfolios are very tough, trust me. You can ask fund managers from unit trusts or mutual funds, right? They can tell you, because these fund managers they are managing open-ended funds. It's very, very challenging. Okay, so I hope this is pretty straightforward. Now, as I mentioned just now, so do I need to construct my own system? Do I need to use Excel? So for us, we do, because, especially for those, for you, if you know how to do Excel, especially if you know how to do some basic formulation, formation, or how to manipulate the tabs and formulas, right? Excel is actually a wonderful tool. It's cheap and you can do wonders with it. But how about for those of us who are not so savvy when it comes to Excel, right? Actually, there are a lot of free tools out there. I'm sure there are more now as the market develops, right? But one of the tools that I normally advocate to use is actually the portfolio manager from i3 Investor. They are not perfect. They are not they do not have everything that you may want, but it's good enough because it's free. Okay, but the only thing you have to do is you have to manually key in your trades, your dividends, your cash interests on your own. You can either do it every day, every week, every month, every quarter, up to you. Okay, this is free, and you can see here they've got very nice visual graphics for you to see what are kind of allocation that you have, what are your performance. Actually, it's a very wonderful tool in my opinion, and it's the best thing about it is it's free. So try to make use of it, right? And opening an account with i3 Investors is free for now, I think so. Yeah, and there are a lot of good things, good resources from i3 Investors which you can take a look. Now, just a disclaimer, I do not represent i3 Investor. I have no stake in it. I am not a shareholder. I'm not even a staff. I'm just sharing with you what are the good tools out there. For ourselves as Spiral Thinker, we rely 100% on our own Excel as well as our own VBA programs. Okay, so this is just a sample. Now, as you can see here, maybe you can find that, wow, our portfolio management system is so complex, right? But basically what I want to talk about tonight is basically just this part: the stock, the quantity, the ABC, the PL, the PW1, all this, right? And for me to go through this, we move on to the next topic, which is what are the basic portfolio parameters for you to get started. Okay, now stock. First thing you got to know is the name of your stock. All right, trust me, although some of you may be laughing at this now, but there are people I know who invest based on stock number, stock code. And that to me is not investing, ladies and gentlemen. That is pure speculation. Nothing wrong with it, but you have to know that you are speculating and not investing. Okay, stock name is very important because you have to know what kind of companies you are investing. For example, you may be, people say, hey, your license analyst or your license fund manager say, hey, Mr. So and so, maybe it's good to look at Genting. So you go and keep Genting or goodbye, keep goodbye. Then hey, you tell your friend, hey, bro, I already bought Genting. Say, huh, Genting? Which Genting do you buy? I say, huh? Got different Genting, meh? Then he say, oh, I was referring to Genting Malaysia or Taiwan, right? So stock name is very important. You need to know what you're investing in. Then quantity. The quantity of the stock is actually the collective quantity after you buy and sell, after you trade, or after the corporate exercises like stock splits, bonus shares, or rights issues, so on and so forth. All right, so this reflects the balance shares, a number of shares that you hold in your portfolio. All right, now you may be wondering, maybe later on you may be asking, David, can I have many different portfolios with different brokers? Yes, you can. But you have to ask yourself, what's the purpose of you doing so? Is it because you want to segregate different portfolios for different objectives? One portfolio for long-term investment, one portfolio for play account, for speculating, for trading, which is nothing wrong, but you need to segregate, yes. But then if your question is, can I combine these different accounts into one portfolio accounting system? My answer will be no, because you will confuse your strategies, your execution methods for different accounts into if you view them in one platform, in one flat layer, right? So I would advocate to have a different portfolio accounting system for different trading accounts. And try not to have too many trading accounts, because trust me, I have known people who lost track what kind of stocks or how many stocks that they hold because they just got too many CDS accounts to take care of. Okay, next is the ABC, which is probably one of the most important or one of the most crucial components in the portfolio management system, in our opinion. And the ABC in our system is called the average balance cost. I think in i3 it is called average cost, as you can see here. Yes. So in different systems, different platforms, they may be called different things, but the concept is the same. Okay. Now, for us, the average balance cost includes the buying and selling a result, as well as dividend receipts and any other corporate exercise. Now, what do I mean? right? Most people will advocate the balance cost as whatever that you get after you buy from a trading transactions, right? Well, from a trading result, but they may neglect the dividends part. For us, dividend part is very important. Why? Because dividend will bring down your cost of holding the share. Let me give you an example. If say you buy a stock of $1 stock at 10,000 shares, so you are buying at 10,000 ringgit, right? That's your value, that's your contract value. Then next month, the company announced 5 cents dividend, so that's 5%. So if you did not engage in any trading along that period, and then the dividends goes X, you still have 10,000 shares, it's 500 ringgit, which is coming back into your portfolio here, as I mentioned here, all right? Because the dividends should increase your cash power. In terms of the portfolio performance, it means that this 500 ringgit should be accounted for in your cost of holding that stock. So instead of 10,000 ringgit now, the cost of holding this stock now is 9,500, and you divide that by 10,000 shares. So your cost is no more 1 ringgit, it is 95 cents. All right. Now, of course, if you engage in trading activities, like if you sell it at the top, when the price goes up and you buy it and you bought it when the price comes down, it will help you to lower your average balance cost as well. For us, every single day, every single week, every single month, we focus a lot on how we manage this average balance cost, because it will determine how we are performing with that particular stock, and then by extension, how our entire portfolio is performing. Okay, price is the latest closing price of stock. It's nothing new. The market value is the quantity here multiplied by the latest price of the stock, which will give you the market value of the stock. Now, remember, just now here, the market value is actually all these different stocks that you hold. They each have a market value denoted at the end of the day or at the end of the week, which will give you the total market value of your stocks here, combined with your cash balance. Only then you know what is your portfolio value at any particular instant in time, right? So that is very important. Okay, only then you can calculate what is your profit or loss. Very simple. Your profit or loss in terms of ringgit is the market value of your stock. Take away your average balance cost. For example, just now, the stock that we talk about, when your cost is 95 cents per share, if the market right now is priced at 1 ringgit 10 cents, so your profit will be 10 cents, or 1 ringgit 10 cents minus 95 cents, that would be 1.5 cents. 1.5 cents divided by 95 cents, that will give you your profit or loss in terms of percentage. Very simple, okay? All right, then the PW is something that you may not have heard about. It is called portfolio weightage. Now, again, in other systems like the i3, I think it is just denoted as, let me see, where is it? It is the percentage after the market value. So this denote the portfolio weightage. Okay, so in our accounting system, we call it the PW, or portfolio weightage, which measures the significance or the weight of your stock with respect to the entire portfolio value. And this is very important. As I mentioned earlier on, one of the reasons why we need to do portfolio management is to know how is about resource management. And this is one of the parameters for you to know how to manage or optimize your resources properly. Now, let me give you a very simple example. If you have found a stock and after your analyst studies, you found, this stock got a potential to be a multi-bagger. Say, I think this stock can go up 200% in 1 year's time. But you only invest 2% in this stock. 2% you multiply by 2 times is only 4%, which means that you are only getting 4% after 2 years. Okay, and compared to another situation where you have 5% or 8% into this stock, and this 8% multiplied went up by 2 times, it becomes 60%. It's a huge difference. Okay, but of course, this PW is also for us to determine or for us to measure whether we may be over allocating for one particular stock or one particular industry. Okay, so these are some of the basic parameters for you to get started. There are not all of them. In fact, there are a lot more, but these should be the essential ones that you need for you to start off, okay? All right, so next we talk a little bit about optimizing risk and performance. It's very simple. So this is a case study again. This is a real portfolio. I think this was from last year. And I do have to apologize. I need to blur out the stock names. This portfolio was at the end of 2021, I think. It has done very well. This is on a, just now the previous case study was on the moderate, right? Now this is a high risk, high growth portfolio objective. Okay. Now as you can see here, just now I talked about stock name, quantity, the average balance cost, the market price, market value, so on and so forth, right? So hopefully you can follow me what I want to share with this case study. Okay. Now on hindsight, this portfolio construction may look quite normal for you, but there are a few things that I want to highlight here. They may not be wrong. It's just something that you have to take care of. Okay. Now, first and foremost, there could be a potential concentration risk for this portfolio. Why? Because if you look at the blue highlighted stocks, number 2, number 3, number 6, number 10, if you add out the 4 PWs, right, the weightages, they will add up to be 47%, which means that although this portfolio consists of 15 stocks, 4 stocks in this portfolio already comprises 47% of the weight, meaning actually it's very skewed. Now, it may not necessarily be wrong because this is a very focused portfolio, which is aimed to achieve high growth. So it is done on purpose. But on the other hand, if you are a more balanced and you want to achieve a more balanced diversification, right, then this probably could be a problem for you that you may need to you may need to mitigate or try to rebalance your portfolio so that it is more evenly spread out. But for us, because we advocate focus approach to portfolio allocation, this to us is no problem. Now next, we may have a problem with category risk because you remember turnaround in terms of riskiness. Turnaround carries the highest risk in terms of in the perspective of Peter Lynch stock categories, right? Now we have one stock here, number 3, which is considered a turnaround stock under the Lynch category, and it has a 12% weightage. Now why is this risky? As I mentioned earlier on, most of the time turnaround stocks fail to turn around, right? So imagine if there is a potential that this stock may lose half of its market value, which means that at 12%, I stand to lose 6% of this portfolio value. So ask yourself, are you okay? Are you okay to with this kind of possibility, you know? But of course, for us, because we know what we're doing, we have done our deep dive research, we understand the business that this stock number 3, which is turnaround stocks that they're operating in. So we don't mind putting a little bit more. And of course, this is not our long-term allocation. Our long-term allocation is about maybe say 6 to 8%. So sometimes we may want to boost the allocation temporarily in a while for us to achieve a higher alpha for our portfolio performance. Now, this strategy we will discuss more in detail in our portfolio timing webinar. Okay, so stay tuned for that. Now, then another potential is we could be exposing too much of our capital into one particular industry, which is technology, as you can see here. All right, almost, in fact, half of our portfolio is weighted on technology stocks. Now, for us, it is by design, but for some of you, it may not be. It may be something that you're not aware of. If you're not aware of, then this is something that you have to take care of. All right. I have met students before when they came to me and said, "Hey, David, I've been doing very well. My portfolios are doing very well." Then I have a look at the portfolio. Hey, of course, do you know that all of your stocks are actually plantation stocks or plantation related? Then they got shocked because they never really categorized the industries that they are looking at. So these are some of the things that you look at in your portfolio construction, as well as your portfolio, as your portfolio matures, right? This is some of the things that you may need to tweak, all right, to find the balance. Okay, so now then, only with all this, right, with all these things that you take care of, right, although it's simple, but it's not too straightforward, right? Then only then you can track your portfolio performance. Now, What do I mean by portfolio performance? Is actually the portfolio value, which includes the market value of the stocks as well as your cash balance. Now, trust me, most of the people out there, especially the kopitiam talk, right? When they tell you about, wow, I made so much money from this stock. Wow, very proud, very proud to share with you how much they win, right? Most of the people won't tell you how much they lost in the stock market. Trust me, no matter how good or precise or how much time you spend in your research, right, you are bound to get some portfolio stock picks wrong, just like this portfolio, right? You can see here, there's a lot of reds, all right, which means that whether it is due to we may have chosen the wrong stock at the wrong time, or because of our trading strategy, we buy high, sell low. Yeah, it happened to us as well. So we lost money in that particular stock in the portfolio. But as a whole, as long as your portfolio is the winners are more than your losers, right? Your portfolio should go up like this. Then you can track your portfolio performance. Is it in line with your own intended CAGR target? So you may have different lines for different CAGR targets. For example, in our case, normally what we like to do is to draw a line for the fixed D rate, which is to us, we put as 4% per annum. And then we have a CAGR line. For this portfolio, because it is high risk and high growth, this green line represents 24% per annum. So for 2021, the market was very opportunistic. We really hit the nail, we hit the nail on the spot. So this portfolio particularly was doing very well. It overachieved. All right. So this is how we track our portfolio performance. Of course, when you overachieve, right, you can take mitigation methods to maybe reduce your exposure so that you won't give back the profits back to the market when the market turns, just like what happens here. Now, of course, on hindsight, I would love to keep 100% cash here so that when the market turns, this portfolio performance will not drag down so much. All right. Now, this is what I meant earlier on as preserving your profits under the resource management factor in portfolio management. Okay. So I hope I give you a very simple a very basic introduction to why we need to do this and that. Okay. And next, so this is just another case study of how we can manage the average balance cost. As you can see here, this is again the same table from the previous slide. I want you to focus on, say, these few stocks here, right? So stock number 2, the market price is 3 ringgit 89 cents at that time, and at the end of the 2021, then the cost is 3 ringgit 10 cents. Stock 3, the market price is 75 cents, then the cost is 80 cents, so it means you lost money, right? Then in stock number 6, you can see here the market price is 293, the cost is 190. So which means that actually there is ample margin of safety, which means this, for example, this stock can go down 10%, can go down by 29 cents to say 2 ringgit and 70 cents, but you will still be making money from this stock because your cost is 190. But of course, it will reduce your profit or loss in terms of percentage as well as in terms of ringgit. Okay, and this stock number 10, the market price was 36 ringgit, our cost is close to 8 ringgit 80 cents. This is very important because if you remember just now, one of the basic parameters I mentioned that one of the most important parameters that we look at is the average balance cost, and this is the reason why we look at it. Now, let me give you an example of what for this particular portfolio, how, for example, in this stock number 2, which is actually in stock number 2, which is actually Inari, back on the 31st of December 2021, how do we achieve an average balance cost of 3.093? Now, let me walk you through it, right? Okay, so this will be the last case study for tonight. Now, this is the export of all the Inari trades we have engaged for this particular portfolio. All right. Now, this you can get this from your broker. Every time you engage, every time your trades are matched, right? Your broker should send you a contract in your email. So for here, we every single trade you record. That's why it's very important for you to record your transactions. Okay. Now for each transaction, you can see here, every time there's a buy, all right, we take money out from the portfolio. Every time we sell, the money is put back. Now you may be wondering, David, why is so complex one? Why you buy and sell so much? Is it because you like trading? Well, the reason for us to trade is for us to manage our ABC, which means we want to reduce our ABC as much as possible for us to increase our margin of safety as well as to boost our profits of that particular stock. Okay, now let me give you an example. Now this table, so what I did was I visualized it into a graph like this. So you can see here the blue line is the stock price for that particular day. The D here are the dividends. All right, the green triangles are when there's a buy transaction. The orange triangle pointing down is when there is a sell transaction. Now, then the blue flat lines here represents the average balance cost. Now, what can you see here? Now, you can see here, initially we got two buys, two purchases of this Inari stock at 263 and 285. All right, 40,000, 40,000. So each makes quantity at 80,000 here. All right. So at the time, the balance, our average balance cost is around 260 something, right? Maybe 270. Now, then when on the 20th of January 2021, we sold 20,000 of this share at 3 ringgit and 3 cents. Now, what can you see here is when we sell the stock at the higher price compared to our purchase price, immediately the average balance cost will drop down. Why? Because it's very simple. It's from this formula here. Okay, it's from this formula here. When our sell is higher than our buy, right, then it will reduce our average balance cost. Simple as that. Okay, right. So as you can see here, as long as you trade in the right direction, meaning you buy low, sell high, and not the other way around. Okay. You should be able to lower down your average balance cost along the way. But you see here, then you'll be asking, hey David, how come you are buying on the way up when the share price is going up? Now, this could be because there is a fundamental shift. There is maybe some updates on the company's outlook. I remember at that time, everyone was talking about Inari going to be incepted into the KLCI. So we believe that at that time, other than a positive outlook for this business, we believe that more funds, especially the overseas fund, the foreign fund managers, will also need to insert this stock into their portfolios, especially the ETFs. So that time we started to accumulate as well. Okay, then of course we were lucky because our investment thesis was correct, our timing was correct. So as the share price was going up, we were trading the stock. So at the end of the 31st of December 2021, this is our average balance cost. And this difference here, the difference between the stock price as well as the average balance cost, is what they call the margin of safety. Now, in terms of if we apply the formula here that I showed you earlier, this ABC formula, and we apply it for these trades, meaning I sum up all my buy transaction, I sum up all my total sales transaction, and then I sum up all the cumulative dividends received for these stocks. All right, so this is the total buy. The total buy is 1.384 million for this portfolio. The total sale is 848,000. We receive a total of about 11,000 ringgit of dividends. All right, you plug into the formula. This is the balance investment cost, 525,000. But because you have a balanced quantity of 170,000 shares, if you take the BIV divided by the quantity, you will arrive at 3 ringgit and 0.093 cents here. All right, so this is how we can come up to this. How we can get this ABC here. Now, the same will apply for all these stocks. That is why it is very good. It will be very beneficial if you know how to at least key in some basic formulas. All these are very basic Excel operations. You don't need to be a genius in Excel for you to do this. Okay, but unfortunately, you cannot buy this Excel tool outside. We don't sell it anyway. Okay, so that was my last case study for tonight. As I promised Shane, right, I try not to go too heavy for my first webinar, especially in tough times like this. So let's come back to the drawing board and recap why, what is the essence of portfolio management and why it is so important. So remember the three major three core reasons as one bonus. Okay, the reason or why is it so important for us to manage to have our own system of portfolio management is because we need to be able to manage the risk, our exposure in terms of capital, in terms of allocation, in terms of industry. We need to have a system for us to measure our performance along the way, to see how far we are from our target, to see whether we need to do some intervention into our the way we execute our trades or the way we allocate in a portfolio. We need this so that we know how to fix the problem. Of course, resource management is very important, as I mentioned, because none of us has unlimited capital at our disposal, even though I love that. And also, not to forget, you have to know how you need to be able to protect your profits so that you can continuously grow your portfolio value over the time. Again, as I mentioned, systemizing and scaling up is something that I will not be talking about today. Maybe I can talk about this sometime, maybe in other webinars, because this is a pretty advanced topic. Yeah. Okay. So that concludes my sharing for tonight. But before I pass it back to Shane, I would like to leave you guys with this quote that I really like by, I think it's Lord William Thomson, or they call him Lord Kelvin. He is the inventor of the measurement parameter for temperature in terms of Kelvin, right? He said before that if you cannot measure it, right, you cannot improve it. And that is why portfolio management is so important. You have to have a system, whether you are using a tool or you build your own system, accounting system, right? Because you need to be able to measure your portfolio risk, your performance, your allocation risk, so on and so forth, so that you can improve it along the way. Trust me, I've been doing this for more than 10 years, right? And I'm still learning every single day. I'm still trying to improve myself even as of today. And trust me on this, the market is very dynamic. If you think that you have known everything, right, trust me, the market will have ways to whip you back to your senses, like what is happening now in 2022. And with that, I hope that you have learned something useful tonight with me. I hope that I've also inspired you to start your own proper portfolio management journey. Yeah. So with that, Shane, back to you. I hope you are not asleep.
Certainly not. Thank you so much, David, for inspiring us on how we can better manage our portfolio by sharing with us different categories of stocks, as well as the different parameters that we can look at when we want to assess our personal portfolio. So if you have any questions for David, our speaker today, you may write in the Q&A box. Don't write in the chat box here, so we can better manage the question. Okay, David, maybe you can go back to the slide where you talk about the 6 different types of stocks, right? Chua would like to ask, could you give examples of different category?
Yeah, no problem. So I don't take too much time, but let me just go through some of the interesting ones. Okay. So as you know that for us, our core is in technology stocks, and most of the technology stocks are pretty we categorize it as fast growers, companies that just now you see Inari, right? Inari to us is a pretty exciting business outlook because they continuously invest in the business. You notice that if you attended Inari's briefing on AGM recently, you notice that they're actually investing a lot of capex into new products, into new machines, into new technology, right? And you know that, of course, you don't expect them to grow immediately, right? You have to give them some time for the business to catch up, for the new product, the new revenue stream to come in, right? So when that happens, right, when they achieve economies of scale, that's where the top line will grow, all right? When the top line grow, hopefully the bottom line will follow, then the stock price should grow up, should follow in tandem as well. So this normally what we categorize as fast growers. Semicon, what other fast growers? Do you think banks are fast growers? No, banks to me are mostly stalwarts because banks are a very established business. Most of the banks have been in business for many years. They are very established. They've got very strong management, right? But they may not enjoy that kind of high growth potential compared to industries like semiconductor technology, all right? Cyclicals, I think you guys know, normally for cyclicals, we refer to the industry that they are operating, the business is operating in. So businesses like oil and gas, plantation, what else? What else? Steel, commodities related. These are all very cyclical businesses and cyclical stocks. But sometimes the stock price may be very cyclical as well. For example, there was a very big debate many years ago when I was with the other company that I work for, right? AirAsia. Some people say AirAsia is a cyclical stock. Why? Because AirAsia airlines, they rely a lot on oil, and oil will affect their bottom line. True. But in our VCs, actually AirAsia at that time, back in 2015, 2016, was going through a super trajectory growth, right? Because of the expansion into the ASEAN market. So that time to us, right? So AirAsia was not a cyclical stock. It was a fast grower. It was it was going through an inflection point towards a high growth trajectory, all right? But unfortunately, because of the COVID, right, AirAsia today is not a cyclical stock. It's not a fast grower stock. It is indeed a turnaround. You get what I mean, Shane? So yes, I hope by using this case study, you can see how one company can go through different categories in the span of less than 5 years, right? But unfortunately, that's the reality. In fact, now they even changed the name to Capital A because they're going through a major restructuring of their business. And that is why today we would categorize AirAsia at best as turnaround. Okay?
Okay, thank you so much for enlightening us. Can you go back to the case studies where you show the 7 stocks in a portfolio, right?
7 stocks. I think it is the first one.
Yeah, that's right. First one.
Is it
this one? In this example that you show, you have 7 stocks in this portfolio. So the question by Gyap Singh is that, say now the stock number 2, which is stock code is UUU.
Yeah.
This one takes up the allocation of 20% in your entire portfolio. So what if this stock drops like 25%? What would you do? Would you reshuffle the portfolio?
Okay. First and foremost, normally for a slow grower stock, which is such a high dividend yield, it is quite uncharacteristic for the stock to drop 25% without any reason. But of course, it doesn't mean that it won't happen. It is impossible. It may happen. Stock market is so fluid, right? But in that case, if there is a 25% drop, so which means that they will translate to a 4% drop, because if you multiply 20% to 25%, the drop will be 4% on your entire portfolio value, right? If I were you, Gyap Singh, right, I would not sell down. In fact, I would be increasing my allocation. Do you know why? Now, at 12.90 ringgit, the dividend yield is 7%. If it drops 25%, which means the stock price is 2.70 ringgit, assuming they're still paying the same dividends per share, right? How much do you think this dividend yield will be? Right? I think the dividend yield will be at least 8%. Because it dropped 25%, which means the yield will go up 25%, about one fourth. So that will be about 8, or maybe 9%. So at 9%, of course, I may regret a bit. Well, how come I put too much allocation so much at the in the beginning, right? But looking at this, right, and the PE would have gone down as well, I would plow more actually. But Gyap Singh, before other than that, actually, I would like to bring you to the concept of the difference between allocation and execution. Now, this is an allocation table, which means that I have budgeted of 100,000 ringgit. I budgeted 20,000 to buy this stock. All right, but it doesn't mean that when the market opens, I will deploy all 20,000 to buy this stock at 290 cents. There should be a proper execution plan whereby, depending on your risk profile or depending on your execution method, you may want to have a staggered system to buy the stock. Maybe you buy 5,000 at 290 cents. And as you know, markets are volatile, it may drop, right? Then you don't buy so much, you deploy another 5,000 at 285, another 5,000 at 280, depending on what you like. So this is more towards it's more related to how you execute your allocation. Now, this is just a budget table. Doesn't mean that you spend it right away. So I hope you get the gist of what I'm trying to say.
Okay. So David, now now the tech stocks are under heavy sell down, right? So
Yes.
the next question is, what would you do with the technology stocks that produce negative ABC, which means in your portfolio?
Negative ABC means free shares, is it?
Yeah, free shares. Yeah. What will you do with them?
Well, my question, in order for me to better understand the situation, you need to know what is your PW. You need to know what is your weightage. Now, if your ABC is negative, or in other words, free shares, but your weightage is very low, maybe it could be 2-3%, right? To me, doesn't really matter, all right? And with the stock price, with the tech stock price taking such a big beating, right? To me, that is a wonderful opportunity for you. Maybe you want to increase your weightage a little bit, but because of the volatile nature in the markets right now, because right now we are not just going through a financial risk. We are not just facing financial risk because of the interest rate regime. We are also facing a hyperinflation regime coming on, which is accentuated by the geopolitical war happening in Ukraine and Russia, which may be possible to extend to other regions of the world, which would most probably affect the entire supply chain shortages situation again even more. All right. So with this in mind, right, I would not go too heavy when I buy back the shares, as we talk about this now. I may go a little bit lighter because the market can change really any direction right now. Of course, because I'm a long term, right, to me, as long as you do not take too much risk, right, it's always okay to buy a little bit more as the price comes down, if the long-term view is still intact, if the long-term prospect is still okay. Now, I would advocate more caution for high growth stocks, especially in the technology sector, because back in 2020 or even 2021, any high growth or any technology, semiconductor stock with a decent growth, right? Fund managers say, wait, 40 times PE, no problem, fair value. But in this situation, right, even though there's no change in the prospect of the business, there's no change in the projected income, right? But by the nature of the market downrating or downgrading the valuation prospects for these tech stocks, right? Say instead of 40 times PE, they feel that 20 times PE is a fair value, which means there's a potential 50% drop of your share price just because of the downrating of the PE. So I would advocate extra caution, especially for high growth stock, not just technology. There are other high growth industries as well. If you have a lot of weightages in the portfolio on high growth stocks, I would advocate you to exercise more caution at this juncture.
Okay, thank you so much for your 2 cents.
Yeah.
All right, so just now you talk about different classification of stocks, right? So Geoffrey would like to ask, what do you think about construction sector under the Peter Lynch category?
Construction, in my opinion, or as far as Malaysian context is concerned, right? And I have to give you a caveat first. I'm not an expert in construction sector, okay? I just know what I know based on how I invest. I would categorize construction as a cyclical sector, right? And particularly, I think it's most countries, even in China, Indonesia, Singapore, right? I think in most of the countries around the world, construction sector relies a lot on government funding and government budget. So unfortunately or fortunately, our construction sector has been on the downtrend for many years because of our political uncertainty, right, and instability. So right now, I think construction sector, even though it's cyclical, is actually at the bottom of the cycle, near the bottom, or I would say. Whether it will turn up or the trend will turn immediately or in the short term, I do not know. It will very much depend on the next government budget. So I don't mind sharing with you that the word on the street is that the government may rejuvenate this sector by pumping more this expenditure into the infrastructure side. So there may be something on the construction sector.
Okay.
Yeah.
Understand. So for investors, right? What is the ideal number of stocks in a portfolio? So that's by Maslan.
This is the golden question, and that's why, Shane, I think that I believe there is a need for us to come up with a new portfolio related topic to talk about how do we optimize the number of stocks, how do we construct a stock, right? But it really depends. That's why I say this is a very important question for you to ponder. It depends on how much is your initial capital. So typically, so this is just a rule of thumb based on my experience. Please don't quote me on it. It's not theory. It's just a very practical experience from my trial and errors, right? Anything less than 100,000 capital, I would not advocate more than 6 or 7 stocks, because so imagine you have 7 stocks, right? And you divide it by 100,000, you are doing on average about 15,000 ringgit a stock. So 15,000 ringgit a stock, to be honest, there are not a lot of choices out there, because remember, there is a liquidity angle that you have to take care of, because if you have 15,000 allocation, you won't probably be able to buy a stock that is worth 10 ringgit, 20 ringgit, or 30 ringgit. You know what I mean? Yeah. So 100,000, not more than 6 or 7 stocks. Anything less than that, 50,000, maybe 3 or 4. Now, the problem is with having less stocks, it means the problem with that is you have to spend more time to do your homework, because your room of error for stock pick is very narrow already compared to when you are having 8-10 stocks in your portfolio. You know what I mean or not? Because if you have 4 stocks and you get one wrong, that's 25% hit on your. Imagine that if you allocate it evenly, right? There's a 25% hit potential risk, right? Compared to an 8 stock, so it's very different dynamics. Now, for higher value portfolios than 1 million, maybe you can stretch it to 12-15 stocks. But in any number at all, in any size at all, I would not advocate more than 20 stocks in one portfolio in any point in time. Because ask yourself, do you have time to follow through the development of 20 stocks in one go? Unless you are full-time. Even myself full-time, I don't have the resources to follow 20 stocks in one go. So normally I will advocate maybe 15 stocks or 15 to 16 stocks for more than 1 million or 2-3 million. Yeah, anything less than that, 100,000, not more than 7 stocks or even less. I hope I answered the question.
Okay, thank you so much, David. So Wai Ying would like to ask, how does one view the performance of the portfolio every month? Because you did a very good graph, okay, in plotting the returns on a weekly basis, right?
Because
how can we do that?
Good question. So for me, because we do this in our Excel, which we develop on our own, so our Excel is quite complex. We did a snapshot every single week. We don't do it every month. We snapshot every single week. That's why you can see every week there's a point, and then we just connect the points here. Now, of course, I'm sure there are tools out there where you can actually capture every week or every day if you want. Even if you use the free i3, right, you can snapshot every week or every month, depending on your how much time you have. Then you can post-process this data to an even more intuitive representation like this graph. Unfortunately, i3 do not produce this graph for you. You have to produce it on your own. So for us, we have scripts for that we develop on our own to produce these kind of visuals automatically, so that we can always assess the portfolio performance and we are able to take the necessary actions.
Okay, this is done using Excel, right?
Yes, for us, everything is done using Excel, but with automation.
Okay, great. So that shall conclude our question and answer session with our speaker, David. So thank you so much for this very informative webinar. I think many of us find it very useful. So if you like this session, maybe you give us 1, okay? If you like this session, you give us 1. Let's see the response. Okay, thank you so much.
Thank you very much.
Okay, let me tell you more about our next webinar. All right. So before that, this is a Bursa Academy, and Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey. So on Bursa Academy, there are a lot of investing resources, be it in the form of articles, quizzes, coursework, video, recordings for you to find. You can go to www.bursaacademy.bursa.com to find more about what are the investing resources that Bursa Malaysia make it available for you. So for our next webinar, is happening on this Friday, which is 2 days later, which will be conducted in BM. Okay, so the topic is perbezaan di antara pelaburan hartanah dengan REIT atau Sharia. So in this Friday, we're going to talk about what is the difference between investing in properties, physical properties, and also real estate investment trusts. All right, so that's what we're going to do. So if you want to learn more, you can register at the link that I've just given you. All right. Okay. So thank you everybody for staying out until 10 o'clock tonight. So hope to see you all again in our next webinar. Thank you, David, for sharing with us your strategy, how you manage your portfolio.
Thank you, everyone.
Yeah. Thank you, everyone. Have a great rest of the day. Bye. See you on Friday.
Stay safe. Stay safe. Yeah. Bye-bye.